Hello everyone, welcome to another series of Mind Map. Today's topic of discussion is monetary policy of RBI. First of all, we will discuss what is monetary policy of RBI, its quantitative measures, qualitative measures, monetary policy committee and effect of quantitative tools. So first of all, let's discuss what is the monetary policy of RBI. Under the Reserve Bank of India Act 1934, that is RBI Act 1934, as amended in 2016, RBI is entrusted with the responsibility of conducting monetary policy in India. The aim of the monetary policy is to regulate the money supply in the economy so as to achieve macroeconomic stability. RBI regulates money supply through quantitative and qualitative tools. The principal tools of monetary policy are repo rate, bank rate, cash reserve ratio, open market operations, and statutory liquidity ratio called quantitative tools. When RBI increases money supply and credit using the above tools, it is called expansionary monetary or credit policy, which may generally be adopted during economic slowdown. On the other hand, when inflation threatens the economy, the central bank may adopt contractionary policy by raising key policy rates. Now moving on to quantitative measures. First is repo rate. Repo means repurchasing options. It is the rate at which RBI purchases government securities from banks for short time with a condition that bank will repurchase these securities. Next is reverse repo rate, the interest rate at which the Reserve Bank of India absorbs liquidity from banks against the collateral of eligible government securities under the LAF. Liquidity Adjustment Facility or LAF. The LAF refers to the Reserve Bank's operations through which it injects or absorbs liquidity into or from the banking system. It consists of overnight as well as term repo or reverse repos, fixed as well as variable rates, SDF and MSF. Standing Deposit Facility Rate, the rate at which Reserve Bank accepts uncollateralized deposits on an overnight basis from all LAF participants. The SDF is also a financial stability tool in addition to its role in liquidity management. Marginal Standing Facility or MSF rate, the penal rate at which banks can borrow on an overnight basis from the Reserve Bank by dipping into their statutory liquidity ratio or SLR portfolio. This provides a safety valve against unanticipated liquidity shocks to the banking system. The SDF and MSF rate is placed at 25 basis points above the policy repo rate. Bank rate, the rate at which the Reserve Bank is ready to buy or rediscount bills of exchange or other commercial papers. This rate has been aligned with the MSF rate and changes automatically as and when the MSF rate changes alongside policy repo rate changes. Cash reserve ratio or CRR. The average daily balance that a bank is required to maintain with the Reserve Bank as a percent of its net demand and time liabilities or NDTL. Statutory liquidity ratio or SLR. Every bank shall maintain assets the value of which shall not be less than such percentage of the total of its demand and time liabilities in India. These assets can be cash in hand, gold, government securities, etc. and open market operations or OMOs. These include outright purchase or sale of government securities by Reserve Bank for injection or absorption of durable liquidity in the banking system. Now let's discuss about the qualitative measures. First is loan to value ratio control. Suppose rupees 1 lakh collateral was required to take a loan of rupees 60,000. However, if the RBI says that only rupees 20,000 loan for collateral of rupees 1 lakh can be taken, then you may not take the loan. In this way, RBI controls the amount of loan distributed to people by banks. Next is consumer credit control. Again, if one wants to purchase a bike worth rupees 60,000, the Honda company asks them to pay a down payment of 10% and the rest as loan. Now, if RBI mandates that a down payment of 30% is required to buy the bike, then one may not buy it. Next is rationing. It involves asking the banks to mandatorily lend to some sector more than the others. For example, the RBI may ask to raise the agricultural credit from 18% to 30% through priority sector lending. Moral suasion. Sometimes, even after the RBI reduces the repo rate, the banks do not reduce the lending rates for loans. In this situation, the RBI governor may speak in colleges or in interview with news channel that it will take firm actions for achieving inflation reduction and direct action. If even after such intimidation, banks do not heed the RBI, it will take action like penalty on banks, etc. to get them to heed the RBI. Now let's have a look at the Monetary Policy Committee. Section 45ZB of the amended RBI Act 1934 provides for an empowered 6-member Monetary Policy Committee or MPC. RBI Governor as its ex officio chairperson, Deputy Governor in charge of monetary policy, an officer of the bank to be nominated by the Central Board, 3 persons to be appointed by the central government. The first such committee was constituted on September 29, 2016. Members appointed by government will hold office for a period of 4 years or until further orders, whichever is earlier. The MPC determines the policy repo rate required to achieve the inflation target. The MPC is required to meet at least 4 times in a year. The quorum for the meeting of the MPC is 4 members. Each member of the MPC has 1 vote, and in the event of an equality of votes, the governor has a second or casting vote. Now lastly, let's discuss about effects of quantitative tools. Reserve ratio. In this, the RBI varies the reserve requirement like CRR and SLR of the banks. If the RBI increases the reserve requirements, then the funds that the banks would have to lend reduces and money supply decreases, so is the inflation. For example, if inflation has increased, then RBI may raise the CRR to 5%, say from 4%, and SLR to 30%, say from 20%. Similarly, if inflation decreases, RBI would reduce the reserve ratios to increase the amount of money with the banks. Repo rate or policy rate. If inflation increases, the RBI increases these rates, then many banks will not take loans from the RBI and hence they will have less money to lend. Thus, the money supply in the economy reduces and inflation would decrease. Conversely, if inflation has reduced, the RBI reduces the rates so that the banks will have more funds to lend and hence the money supply would increase, which increases inflation. Open market operations. To manage inflation, RBI buys or sells G-Sec. It is called open market operation. If inflation increases, RBI would sell G-Sec to banks. Thus, they will have fewer funds to give as loans, hence money supply in the market reduces and inflation would come down. Similarly, if the inflation reduces beyond reasonable levels, RBI would buy G-Sec from the banks. Thus, money with the banks would increase too, and therefore money supply in the economy would increase, which would increase inflation. Now it's time for the practice questions. First of all, note down the prelims question which was asked in 2015 exam also. Question is, with reference to Indian economy, consider the following. 1. Bank rate. 2. Open market operations. 3. Public debt. 4. Public revenue. Which of the above is or are component or components of monetary policy? 1 only, 2, 3 and 4 only, 1 and 2 only, or 1, 3 and 4 only? You can send the answer of this question in the comment section. Now moving on to the main question. What are the monetary policy tools? Analyze the performance of Monetary Policy Committee or MPC. So that's all for today. Stay tuned for the next episode. Thanks for watching.